Hey friends, welcome back to the channel. I'm Iggy, and if you're new here, I cover everything about growing your wealth, stocks, CPF strategies, and breaking down the economy in ways that make sense. Fun fact, the investing Iguana was ranked 8th in Tiger Broker's 2024 Influential Tigers, thanks to all of you. With over 768,000 reads, 53,000 likes, and 700 videos clocking more than 300,000 watch hours, this channel is all about helping you make smarter financial decisions. Today's topic, US bonds are in chaos, and it has ripple effects even here in Singapore. Let's dive in. You might be wondering, why should someone in Singapore care about what's happening with US bonds? Aren't they just some boring financial instruments for big shot investors? Well, here's the thing. US bonds are like the foundation of the global financial system. When they wobble, it's not just Wall Street that feels it. It's your CPF returns, your investments, and even the price of your groceries here in Singapore. Sounds dramatic? Let me explain. Let's start with the basics. Think of US bonds as IOUs issued by the American government. Investors buy these bonds because they're considered safe. In return, they get regular interest payments. It's like lending money to a friend who has a solid track record of paying you back on time. But here's where things get tricky. Inflation. Imagine lending your friend $100 today with the promise of getting $110 back next year. Sounds good, right? But what if inflation makes that $110 worth less than $100 today? That's exactly what's happening with US bonds right now. Investors are worried that rising inflation will eat into their returns. Inflation is like a sneaky thief that slowly chips away at the value of your money. In the US, inflation has been stubbornly high, despite efforts by the Federal Reserve to bring it down to 2%. This has caused bond prices to drop because investors demand higher returns to compensate for inflation risks. Here's an analogy. Imagine you bought a movie ticket for $10 last year, but now tickets cost $12 due to inflation. If someone offers you a voucher for $10 off a future ticket, it doesn't feel as valuable anymore because prices have gone up. That's how bondholders feel. They're holding on to assets that don't seem as attractive in today's high inflation environment. You might think this is an American problem, but Singapore isn't immune to these changes. Our interest rates often follow US trends because of our open economy and currency policies. When US bond yields rise, borrowing costs here can increase too, affecting everything from housing loans to business financing. For example, if you're planning to buy a BTO flat or refinance your home loan, higher interest rates could mean paying more each month. It also impacts CPF returns since part of our CPF funds is invested in government securities influenced by global interest rate trends. Now let's add another layer of complexity, tariffs. The US has been imposing tariffs on imports like steel and aluminum, which drives up costs for manufacturers and consumers alike. Think of tariffs as a tax on goods coming into a country. It makes everything more expensive. Here's a relatable example. Imagine you're buying durians imported from Malaysia. If Singapore suddenly imposes a tariff on durians, sellers will either raise prices or absorb the cost themselves, which isn't sustainable. Either way, you end up paying more or getting fewer durians for your dollar. Similarly, when the US imposes tariffs on Chinese goods or steel imports from Canada and Mexico, it creates a domino effect that raises prices globally, including here in Singapore. Let's look at Ford as an example of how tariffs can disrupt industries. Ford relies on imported steel to manufacture cars. When tariffs increase steel prices by 25%, Ford faces two bad choices: raise car prices, which could hurt sales, or absorb the costs, which eats into profits. Either way, it's bad news for both the company and its customers. Now imagine this scenario playing out across multiple industries worldwide, from electronics to construction materials, and you'll see how tariffs contribute to inflation and economic uncertainty. So what can you do as an investor? So how do you navigate these choppy waters? Here are 3 steps you can take. 1. Diversify your investments. Don't put all your eggs in one basket, whether it's US bonds or local stocks. 2. Consider inflation-protected assets. Look into options like Treasury inflation-protected securities, TIPS, or savings bonds and Treasury bills in Singapore's context, or commodities like gold that tend to hold their value during inflationary periods. 3. Stay updated. The global economy is interconnected. What happens in one market can ripple across others. Keep yourself informed so you can adjust your strategy when needed. For instance, Singapore Savings Bonds, SSBs, could be an attractive option for risk-averse investors right now. With current yields around 3% for 10-year bonds as of early 2025, they offer a relatively stable alternative compared to volatile markets. Some of you might be thinking, but I'm not an economist. How do I make sense of all this? That's exactly why channels like this exist, to break down complex topics into simple terms so you can make informed decisions without feeling overwhelmed. Another concern might be timing. Should you invest now or wait for things to stabilize? The truth is, there's no perfect time to invest. What matters is having a clear strategy aligned with your financial goals. If you're feeling uncertain about where to start, review your portfolio and assess its exposure to interest rate risks. Explore low-risk options like SSBs or fixed deposits if you prefer stability. Consult a financial advisor if needed. They can provide personalized advice based on your situation. And remember, investing is a marathon, not a sprint. The current chaos in the US bond market might seem far removed from our daily lives here in Singapore, but its effects are closer than you think, from CPF returns to housing loans and even grocery prices. By staying informed and proactive, you can turn these challenges into opportunities. What do you think about all this? Are US bonds still worth considering? Or is it time to explore other options? Let me know your thoughts in the comments below. I'd love to hear from you. If this topic got you thinking about how global trends shape our financial future, don't miss my related video. Ex-Singapore minister explains why US dollar's reign is threatened. It dives deep into why the dominance of the US dollar might be at risk and what it means for Singaporeans like us navigating an increasingly unpredictable world economy. Until next time, stay safe and keep investing wisely.